Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, January 21st, 2021. In this video, I'll start with a quick updates on the U.S. markets, the stock market, and the euro. Very brief, just updates there, and then roll into a few trade ideas, updates of some of the recently highlighted trade ideas, as well as a couple new ones. Keeping it short, not a lot to cover here. I'm just going to go over a few different things. Start out. I have some primary trend lines I want to share that now I think are valid. I've recently updated these. So these, I believe, are the most important trend lines to watch. The stock market is in a unmistakable uptrend with zero sell signals. We have came close recently, but never confirmed those bearish engulfing candles. So on this most significant daily time frame, remember, don't get that confused with intraday charts, 15, 60-minute charts. This is what we need to see, and even better if we get them on the weekly time frame. But that's what we're looking at now. So I'm going to actually, I don't know if I've done a set alerts here, and I'm just going to cover the major indexes. So I have a price alert there. That trend line, if you're trying to replicate it, comes off the March lows. That's a major reaction low, obviously. And I use log scaling. Make sure you use log scaling. You're going to hit the trend lines will not match. We have reactions there, like late October during that correction, and then a couple reactions recently, which helped to validate that trend line. So it's a pretty decent trend line, and again, I think it's the one to watch now. That's how it looks on SPY. We continue to diverge higher. The negative divergence continues, but as I always say, divergences and overbought conditions, those are kind of warning signs or indications that you're probably going to get a trend reversal soon, but no guarantee. You need that sell signal, and that could come in. It could come in the form of different types. Maybe a candlestick reversal pattern, something along those lines, or and again, in this case, a break of the trend line. That's what SPY looks like. Broad market. Here's QQQ. I'm not going to go over it in this video, but I've done in several recent videos highlighted some key levels, and I used yellow trend lines or price support levels to denote the most significant levels on the market leading FANG stocks. They are all above trend. In fact, most of them tested those levels or came close and have rallied off those, so they remain above trend. The market's not going to break down until the FANGs break down. And as far as the index goes, so the NASDAQ 100, we have a comparable trend line that I just gave you on SPY. It starts off the March lows, has that October reaction, major reaction low, and a couple reactions there. So on this one as well, I will set an alert, and you want to see both of those go to help increase the odds. These are all potential targets, and the same ones I've laid out recently. So that's QQQ. Like I said, uptrend continues with the divergences building and walking up to that trend line, waiting the next sell signal. Why am I talking about sell signals? Why am I not talking about buying the market? Well, there's no objective entry. We're in an uptrend. You can add money in an uptrend. It's random. It's going to continue until it doesn't. But we don't have, when a security's trading at all-time highs, there are no resistance levels overhead to break out and trigger an objective entry. You can buy pullbacks to support. You can use the very same trend lines I just showed you. That's one way to do it. Other than that, you're just randomly adding. So that's what we're watching here. And here's IWM. The best I could do now is this comparable trend line right here off the lows, and we're well above it. IWM, the small caps have outperformed the large caps lately. So there's your trend line there. Late September reaction low, and in November they've been kind of doing their own things. And other than that, I think the sell signal will come. This is going to come a line closer to those trend lines on QQQ and SPY. This is a price channel, pretty tight price channel the small caps have been in recently, with one little whipsaw right there. That was a whipsaw signal we had, breakdown on the 60-minute charts. It was a little bit of a correction there, but we have enough reactions, I think, to make it valid. So that would be the potential sell signal there on the small caps. All right, moving on. As I've been putting a lot of effort and focus on lately, the US dollar and the euro. I use either or. I watch them both, but here's a euro chart. It's pretty clean, the levels that we've been hitting, bouncing off of. That was our primary trend line there. Broken, gave us a sell signal, back test, hit my first target zone, bounced, hit my second target, bounced, and I gave you just yesterday this bounce target range. It's three distinct support levels, all in close proximity, and so far we've rallied up now to about a little shy, right about that second target there, potential resistance level, I should say, at 121.94. The divergence that I pointed out yesterday has continued to build, so we have some negative divergences building on this bounce, and that's why I favor, one of the reasons why I favor another leg down in the euro, which would be another leg up in the dollar. If and when that happens, that will most likely put pressure on the equity markets and quite likely be the catalyst for that breakdown. So no reversal yet. If we push higher anytime soon like this, I'm just extending these lines, we'll continue to extend those divergences. And as I said, ideally, not absolutely necessary, but ideally for the bearish case, we should remain below this 122.36 resistance level. Because if we go much above that, we're going to have taken out that major reaction high right there, and it calls that whole uptrend into question, or the larger downtrend. What I'm talking about here is this is an intermediate term or a longer term uptrend with a shorter term downtrend that is still in play right now. But what happens is you take out each of these previous reaction highs, it starts to call it into question, and that one right there is the one that I'm really focused on. So that's still where I'm leaning, and move down here to that third target zone. Again, I've covered euro plenty lately, so I'm not going to spend any more time on that. Just want to let you know where we're at, and the fact that it's up a little more today than yesterday is most likely, well, almost certainly, goes hand in hand. It's not the sole reason the market's rallying, but it is not mere coincidence. Those are pretty much moving together. Okay, trade ideas. Let's move into that. I've showed you. We'll start with Bitcoin because I've showed you recently the extremely tight correlation between the dollar or euro and Bitcoin. This is Bitcoin futures. I posted this chart on the site recently, but I just added an updated level here. What we have is uptrend line right here. This is a 60-minute chart, by the way, guys. I know I'm covering quick. Let me move it down so you can see it in the video. BRR, that's the symbol for the Bitcoin futures. You can trade GBTC. It works kind of like an ETF, so if you don't have a futures account. But this is good to track these Bitcoin futures as well, whether you're trading the futures contract. There's a longer term trend line we might visit soon. And we had a series of near-term uptrend lines. That one broke, gave us a sell signal there. Came on, hit the secondary trend line right there. Bounced again, bounced, rode it. This was pretty valid, and once we broke it, boom, it took us down right to that previous reaction high. So we're at support. We hit support today. Support is 31,227. It is that previous reaction low. It is these reaction lows right here, and there's a gap just below. If and when that goes, that gives us our next sell signal. Whether that happens or not, I think will largely, it doesn't have to exclusively depend on the euro, but largely depends on whether my euro scenario plays out. So whether or not there's a little more upside, if the euro starts another leg down, takes out the recent lows that it hit around that T2 level. Again, I'm talking about the euro futures E7 that we started out with, then that should open the door for a move down here to the next support level / target at 26,570, and potentially down here to the trend line as well. Worst case scenario at this point in time, I'm not going to say worst case scenario, but maximum downside I'd see is a move to about 19,661. That'd be a heck of a fall, pretty big move in Bitcoin if it happens. I gave you, since a lot of people don't trade futures, I gave you proxies. You can, again, one proxy is GBTC, tracks the price of Bitcoin. So far, since I highlighted that the other day, it's dropped about 26%. But what I like to trade Riot and Overstock. I already mentioned Overstock broke down. Well, let me start there. Way back here, I gave an update. I did a video that day, covered it recently on October 25th. So we already had the sell signal, and we've already come down almost to my maximum or final target that I laid out at that time, 42.41. So there's not nearly as much meat on the bone for short on Overstock. From that breakdown into the recent lows, that was about a 52% drop. So the other day I highlighted the one that had more potential is Riot, and Riot went on to break down the day after of that video. I think it was up in this price channel here. There's your breakdown candle. It was flirting with it that day, but then you can see at the end of the day we closed comfortably below it. There was your sell signal. So from the breakdown point into today's lows, that's already about a 20% drop right there. And again, just a lot more meat on the bone for a Riot short, because the move has already played out, most of it, I believe, in Overstock. This was a price channel that was negative divergence right here at the recent high. Helps to support the case. There's your sell signal. Since that last update, guys, I gave you originally a target here of 11.18. I added a level here for those of you that, I know there are a lot of people that think, oh, no, it's not going to drop 50%. I mean, that's what this stock does. It rallies 50, 100%, it drops 50. So when I gave you that target before, I told you it was about 53% if that 11.18 target's hit. But for those of you that might, are longer term bullish on Bitcoin and Riot, and you just want to get a quick, 35%, that would be down to that 15, 50-ish target. Cover a little bit above. These are unadjusted targets. That means that's the actual resistance level. If all eyes are looking at 1553, sometimes the buyers step in early, so you might want to cover that one at 1558, 1560, 61, somewhere around there, a little bit above there, if that's your preferred target. But as of now, this is, the path I see Riot taking. And if we get a real nice rally in the euro, big drop in the dollar, big reverse on Bitcoin, and there is a potential to come all the way back down here to about that 428 level, and that would be a monster short on Riot from the breakdown level, should we get there. And it's a big support level. That's about an 81% drop. And, to do it, you might be saying, Randy, that's crazy. You're not going to get 81% on a short trade. It's, it's not, unusual for a stock like this. There's the Fibonacci retracements right there. To hit that target would be a 61.8, and you can see how well that lines up. That's why I'm really liking that 11.18 target. But longer term, you can see where the stock has come from. And I could easily see a move back down there again if Bitcoin would really have to take it on the chin. Or maybe something goes on with Riot, but it tends to move in line with Bitcoin, as you can see. It's not mere coincidence that, and there's a drop in Riot, there's a drop in Bitcoin. They're almost hand in hand. Okay, and so, congrats to those that caught it so far. Good for 20-something odd percent, but I think there's still more to go. Maybe just lower your stops to break even, or even lower if you want to protect profits. Next up, well, we're on the short trades, and more you're going to hear. I'm finding more short setups. I've been struggling. I know there's, I imagine a lot of you out there that don't like shorting or think it's, silly to short in such a strong market. But there are just not many objective. It's getting harder and harder to find objective long entries. I have one or two here I'm going to show you in just a second, some setups. But let's update XOP. This is, the right now, to me, the energy stocks are the most bearish sector in the S&P 500, whereas back right before the elections, I said the energy stocks were the most bullish looking setup in the energy sector. So we've come full circle. XOP from the breakout, rallied 65% just since the election. And again, I'm not going to go over and over all the reasons, but this one was basically a short the other day, last week, based on a rally into resistance, overbought negative divergences, and starting to move down off that. Now we're getting that rejection off that resistance level right there. We hit it and we stalled out, and now so far today we're moving, starting to move impulsively lower, about a 3.4% drop in XOP. And I gave you an alternative or secondary sell signal for those of you that wanted, a little more evidence or wait to add to position, and that would have been and was a break below 68.93, which we got today. So there's my second objective entry, came earlier today, or add-on. And again, so now we've taken out this little wedge pattern here and starting to move lower. Last time we had a wedge pattern with a comparable divergent high right there. From the highs, we dropped about 13%. Not from the breakdown levels, but from the highs before that. So I think there's still more downside here. I've laid out the targets, and I've also mentioned DRIP as a proxy. I want to mention somebody, I was catching up on the comment sections today from the last update on DRIP, and a member pointed out to me that DRIP is 2-time leverage, and I appreciate that. It's always been, in the past, for years since it came out, it was 3-time leverage, and its counterpart Gush was also a 3-time or 300% leverage. But what happened, and I just didn't catch a memo on it. I do know a lot of ETFs in the last couple years. We had that big drop in the last quarter of 2018. and also, or was it 2019? And then the big drop into the COVID lows in March of 2000. And during those periods of volatility, a lot of ETFs blew up, leverage ETFs. Some of the crude ones, they went away. A lot of the VIX ETFs, especially those that are leveraged, blew up and went away, meaning gone. You lost all your money, or some just delisted, gave the money back. They couldn't sustain that model. The way they work with derivatives and all that, it got too costly, or the derivatives would blow up on them. And what others did, like Drip and Gush, as well as Nugget and Dust. You guys remember those? Those are popular gold mining ETFs that track it's like GDX, but with 300% leverage. They went down to 200% leverage also I think right after the drop into the March lows. So just a correction. However, my percentage gains are still correct from where I posted it the other day, last week, as a trade idea. I was measuring using the measurement tool in this charting platform, and just to reiterate, I'm still favoring this one right now. That's T2. I'm trying to circle it. That's my preferred swing target. This is a potential target if things get ugly. I'll need to see the stock market roll over. I'll need some solid sell signals on the S&P 500 to open the door to this target. So I'm open to it, but I can tell you right now, if I had to place, OCO orders, which I like to use, those are one cancels the other orders, and what you do with an OCO order, and I highly suggest using these. I've done videos on them in the past and written articles about them. When you buy a stock or an ETF or whatever it is like this, you set two orders. You go in, and if you don't know how to do them, just ask your broker. Find your broker. I'll have a help section. Sometimes they call it OCA, and that means one cancels another, or one cancels the others. And so you have your stop loss order, or no, stop order here. That's a stop if you're long, STOP, and stop loss order. So wherever that is, let's say you bought it here, you have a stop loss here, and that's your target. So where I was going is, if I was going to sail around the world for a year with no communications, no internet, I would set right now a stop loss. And it's leveraged. So I'm watching this. These targets are somewhat flexible because I'm going to watch XOP. You get some. Well, sometimes it's decay and sometimes it works in your favor. I've talked about that quite a bit. The leverage, 2 or 3 time leverage, when you get a strong move, which I think is what we'll get in the energy stocks, you actually do better off putting, let's say, half your money into a 2-time leverage ETF than shorting the non-leveraged, in this case XOP. And again, that's only if you get those pretty strong rips or dips like that, what I like to call a unidirectional trend, where it's not. This is when you don't want to own leverage ETFs and it's choppy markets. This is when you want to own them right there in those straight, pretty strong moves down or a strong move up. So that's that. So roughly, again, from where we were last week, about 60% of T2 is hit. And that's where I would, right now, that's my preferred target. So this is and again, we'll see if it doesn't pan out. We move on to the next one, and that's what stops are for. But this is the path I think it'll take. First of all, I want to say you're looking for a potential breakout there on Drip, although the XOP chart is more important, I believe, than Drip. Get a reaction there on T1 and then move on up and hit T2. And that would be a healthy correction in the energy sector. And going back to XOP, the comparable level would be, I think, right about here. So that would represent a drop of about 15%. So what I'm looking at is these reaction lows right here in XOP that go right back into the beginning of the year. You can see right there. And we flip back to DRIP. And that's it, the same. This is inverse. You flip XOP over, and that's why those are the reaction highs into the January 4th lows. And there's an example of how, if that is hit, that's going to give you 63%, whereas if you short XOP, from where I mentioned it last week, somewhere up here, that comparable move would be only about 18%. So you take 18% times 2, that's 36%. Again, okay, hopefully that makes sense to you guys. And I do that because a lot of people bash those leverage ETFs, saying they're garbage and they should only be used as day trading vehicles. And again, I am absolutely will tell you that you don't want to sit and hold them for a long time. You just got to get in those, again, hold them if you think it's going to be a fairly unidirectional rally or correction, and that's again the way I'm leaning. So that's why I have drip. Oh, let's cover the rest and we'll move on. Give you the guys the other trade ideas. XES, that's another one. You get more bang for your buck on XOP as well as XES than you do on XLE. Those are the three big energy ETFs that I usually cover. I covered them back in November, covered them many times in the past, just due to the types of companies. This is oil and gas, equipment and services. Same thing. It's so far a rejection off that 55.44 target, down 4.25% today, and potential targets. You can see trend line back test 47.75. Those are your near-term targets for XES, and then XLE, and this is closest to the if you're looking at the weighting in the S&P 500, the sector, I should say. There's 11 sectors. Energy is one of them. This is probably closest to tracking that basket of stocks. And again, it's down 3.13%, by far the largest loser in the S&P. So, you can short in a bull trend. That's what I'm saying. You just have to sniff out the charts with the best looking, the most bearish charts, or find those objective entries. But again, it's these divergences and everything else I see that tell me we can get quite a bit more than just a 5-6% pullback like we've already had in that sector. All right, moving on. I'm going to cover a couple long ideas. This one is super speculative. Oh, we're back. Okay, so earlier today we're back below there and we're starting to break out. I was, just found this one just combing through things. This guy here got delisted off the Nasdaq, but it was delisted down to the Nasdaq over-the-counter market. So it's an OTC stock now. These biotech stocks have been ripping, a lot of them. Everybody's tripping over themselves to buy biotechs lately. And what happens is that ship has long sailed. I'm about to show you the biotech sector is a short setup. But if you're, what happens during strong rallies like this, and this one is based purely on momentum and everybody just trying to chase. It's the fear of missing out rally at this point. Fundamentals just do not remotely align with where stock prices are right now. We're in a recession. It's the first time in history, I believe, that we've been in a recession for almost a year now, and we're still in that. It hasn't been declared out. We're not out of the recession, and the stock market's at all-time highs. That doesn't happen. Anyways, so fundamentals are not aligning with what's going on in the stock market, but it doesn't matter. Just like the dot-com stocks back in 1999, 2000, it didn't matter. There were a lot of people that were shorting them, or saying this is insane, but they kept going up. They're going to go up till they stop going up. When they come down, they'll come down hard. And what happens is towards the tail end of those rallies, since a lot of the bigger names have already rallied and gotten way ahead of themselves, you start to see this dash or trash and people looking at these lower quality ones. And so this one I just want to mention as a breakout above that 0.0210 level. It's taking it out today. It had a couple whipsaw. That was a whipsaw, but this one popped and it hit that 0.933 target right there. So a lot of upside potential. And again, uber high risk. This is your Vegas money, but that first target there is about 68%. If I were to give it a second target, let me see if I can give a downtrend line here. Well, the downtrend line would show a breakout. And there's a big old gap to be backfilled. So a lot of upside potential. You just may want to set a stop and let it run. But again, uber high risk because that's a very low price penny stock. This one's a little bit better. HSTO, was that? Yeah, Histogen, another biotech. Nice clean downtrend line. Look, it's only just out of penny stockville. It's $1.12. Recently entered penny stockville, but I find that's typically bullish when a stock drops below $1 a share, because then they face being delisted if they trade under $1 for too long. And so the company will often try to do what they can to get it back above $1. And if it regains that dollar level, there's dollar right there, then that's usually bullish. But the bottom line is this one is a trade setup. There's your downtrend line, nice and clean. This is positive divergence right there. Last time we had a comparable setup was right here, well, divergent low. We didn't really even have a clean downtrend line, but from that divergent low, we rallied from 246 up here to about a little over $7. That was a 192% return. My target this time around would be 246 as the first target. If if it keeps going, you want to trail up stops. That's what a lot of things have been doing in this market. You can hold out for $7. That would be the next target. Well, let me give you one more stop along the way. Most likely reaction right here, around right around 458. So there's a trade setup. Also on the aggressive side, it's getting harder and harder to find objective long entries. And let me show you a couple more and we'll wrap up here. As far as sectors, I've been combing through various sectors. And then what I'll do is if we start to get some sell signals in the broad market, then I will find individual stocks within those sectors. But ones that look toppy to me or ready for a correction before some others. Transportation sector right here. This is IYT. Here's a nice trend line off the March lows. Several reactions, a little whipsaw lately, but you can see it's been building this negative divergence for quite a while. And target would be, I think, would come back down here, give or take. I haven't sharpened my pencil on the targets, but about 200. I think we'd be looking at ultimately about at least a 11-12% drop with a first stop there about 214 right there on IYT. Again, trade setup. Not a huge downside potential, but one that I think is ready to crack before the broad market. Another one I mentioned earlier is biotechs. Biotechs have been running. I don't have a very clean uptrend line, but I can see for the first time in a while we have some pretty strong negative divergences building right here, and they've gotten really ahead of themselves. Last time we had negative divergence was right here, then here, then here, and then here. Let me measure those out for you. Just if, even in a bull trend, you can short the biotechs. That was a drop of 17%. This was a drop of, I can't grab right on the trend line or it moves. It was a drop of 36%, and the one before that to this low was a drop of 22%. Where would this one go? Minimum, I think, right here. Give or take around 122.50, and that would be a drop of about almost 20%. LABD is your ETF. That one's still 3x, I guess. See, these are a few of the 3x maintain their 300% leverage. So there's an option for you there. And you can see here, positive divergence right there on the PPO. Very oversold right here. I was oversold there. Last time we were that oversold. There was a rally to be had of about, if I can grab the bottom there, of about 166%. So that's where we're at right now. I'd have to clean up this chart. I really prefer to use the chart of XBI, the one I just showed you, for identifying the entries and exits. But this trend line is close. So there's LABD. Again, it's a 3x inverse of XBI. And by the way, it does track the same sector. There's other biotech ETFs out there, but LABU tracks the Spider's S&P biotech sector, whereas your other biotech ETFs are IBB, for example, and that's the NASDAQ biotech index. Same story, you get these divergences have been building here, and these guys are getting pretty stretched. And last but not least, again, another sector, and I highlighted a few weeks back, Powell's been keeping the pedal to the metal on low rates, and that's been helping banks, and really what helped banks too. This last surge, since I talked about them here, was that breakdown in treasury bonds. Remember a few weeks back, I highlighted the triangle patterns on the 10 and 30-year treasury bonds. Both end up, which broke to the downside, and we had the biggest move in a long time to the downside in treasury bond prices, which meant yields went up. Well, that helps the banks. The banks make money. The primary way the banks make money is called the spread. Banks take money in from you and me, and we put it in our checking accounts, savings, and CDs. So banks take in deposits, and they pay you X, which right now is near zero. That's what they're paying you. And they turn around, they loan that money out to other people, in businesses, car loans, mortgages, business loans, and they lend that money out at Y, and that's the spread, and that's how they make money. So right now they're paying you anywhere between 0 to about 0.5% on your deposits, and they're turning around because of that recent surge in Treasury bonds that has widened the spreads now. That's really helps the banks. And again, whether that lasts or not, we'll see. Won't last forever for many reasons. But anyways, I wanted to point out that there we are. Major reaction highs. This is where XLF is capped out in recent years around this level. We have some negative divergence there on the PPO. Last time we were this overbought was, goodness, all the way about right here to this extreme overbought reading. Let me zero in on there. That was a reading of about almost 80 on the RSI, and from there, that's where the financials drop. Well, yeah, from there they dropped about 27%. I got pretty overbought there. So just something to note, at resistance, overbought with divergence, similar to the energy sector, although I prefer the energy sector right now. I just wanted to point out some of the sectors in the S&P 500 or subsectors like transportation and biotechs that I think are set up to lead the way down or break down first. But at the end of the day, I'm just going to loop back to where I started the video and we'll wrap it up. Until the major indexes break down, you're not going to have any monster shorts on their subsectors in there. It's going to limit that because all those majority of what I just covered are components of the S&P 500, and it's all about inflows, money moving into the market, into these ETFs, and being spread, among all those components in there. So you need to see the tide change, and then some of those sectors and setups that I showed you should outperform on the downside. That's what it's all about. So as of now, I'll continue to scour for long side setups, and if I see any, I'll let you know. This has been Randy Finney with the right side of the chart. Have a great day.